In the next few minutes, I'm going to show you the exact strategy I use with my clients to help them pay off their mortgage years faster without earning any more money or making massive sacrifices. If you're like most homeowners, you're probably looking at your mortgage statement thinking, there's got to be a smarter way to do this. You're making your repayments every month, but it feels like you're barely making a dent in that principal balance. I'm Chris Moore, I'm a mortgage broker here in Perth, and over the past few years, I've helped my clients secure over 200 million in home loans. And with every client I speak to, I have this simple conversation to help them shave years off their home loan without changing their lifestyle at all. Now, the biggest misconception people have is thinking they need to make extra payments or earn more money to pay off their mortgage faster. But what I'm about to show you is much simpler. It's about being smarter with the money you already have. And it all comes down to understanding one key thing. Let me explain. So basically what you need to know is that no matter how your mortgage repayments are set up, whether it's monthly, fortnightly, or you have it debited every week, the interest on your loan is calculated daily. So let's say you've got a $500,000 loan at a 5.5% interest rate. Every single day, the bank actually calculate 5.5% interest on whatever your outstanding loan balance is. And this is the key to everything I'm about to show you. Now, if you're like most people, you probably also have a separate savings account. Having savings is of course very smart, but let's do the math on having it in a separate account, not attached to your home loan. So for this example, let's assume you've got $10,000 in a savings account earning you 4.25%. Well, you're actually losing money every single day. Why is that? Well, because you're actually paying a higher interest rate at 5.5% on your mortgage while only earning interest at 4.25% on your savings. It's a difference of 1.25% that you would have been better off if you were to just have put the money into your mortgage offset account. This also doesn't take into account the tax that you need to pay on the interest earned each year in your savings account. So after accounting for tax, that 1.25% differential is going to be even bigger. This is what I call lazy capital, and I see it everywhere. People have their money scattered across different bank accounts, a bit with this bank because they don't charge international fees, some with that bank for everyday banking, maybe a high interest account somewhere else, and then their home loan is with another bank, for example. But this is where your offset account becomes your best friend. An offset account is simply a savings account that's directly linked to your home loan. You can use it just like a normal account. It comes with a debit card. You can pay your bills from it. You can buy groceries, whatever. But here's the magic. Every single dollar in that offset account reduces the balance that interest is calculated on. So going back to our example of a $500,000 loan with $10,000 in offset. Instead of paying interest on $500,000, you're only paying interest on the difference between the two. So in this case, $490,000. That might not sound like a much, but just remember, this is calculated daily. Let me show you exactly what this means for your repayments. When you make your monthly repayment, let's just say it's $3,000, part of that payment goes towards interest and part of that payment goes towards principal. To show you how this works with numbers, and just to be very clear, these figures are purely for illustration. Let's just say that in this example, $2,500 goes towards interest and around $500 goes towards principal. When you put money into your offset account, you're effectively reducing the interest payable with each payment. Remember again, interest is calculated daily, but charged monthly. So with $10,000 in your offset, the interest may only be $2,400 with $600 going towards paying off the principal. With money in your offset, less of your repayment goes to interest, which means more goes to paying down the actual loan balance itself. What starts to happen is this creates a snowball effect. As more of each payment goes towards the principal, your loan balance drops faster, which means even less interest next month, which means more principal reduction. It compounds on itself. So you still have the savings account, it's just now linked to your home loan and is helping you pay off your loan faster. Now, there's a very specific way to structure this that most people get wrong, and I'll show you that in a moment. But first, let me address something I get asked about all the time. Chris, what if I've got an investment property as well? Where should I link my offset account? And this is a really critical one to get right. Now, if you still have debt on your owner-occupied loan, then the mortgage offset account should always be linked to this facility, not your investment property. Here's why. The interest on your home is what's considered non-deductible debt. You get no tax benefit from it at tax time. But the interest on your investment property is what is called tax deductible. So if you put $10,000 offset against your investment property, you're actually reducing the tax deductions while still paying non-deductible interest on your home loan. You're essentially reducing your potential negative gearing benefits, which is one of the main reasons many accountants advocate for investment properties in the first place. So you don't necessarily want to be reducing the mortgage on your investment property because this is what we would classify as good debt, and it gives you a secondary tax benefit. Instead, until your owner-occupied loan is paid off in full, this is where the focus of rapid paydown should be directed. To do that, here's a strategy for paying off your mortgage faster. First, consolidate everything. Unless you have a legitimate investment vehicle that earns you an annual interest rate higher than you're paying on your mortgage, every dollar you have should be in your offset account. Stop having money scattered across multiple accounts earning taxable interest while you're paying higher interest on your home loan. Like I said before, this is lazy capital, money that is not working for you as hard as it could be. The second is understanding your own psychology. Some of my clients prefer using their loan's inbuilt redraw by making extra payments instead of the offset account, because once they've paid that money into the loan, it feels like it's gone. And to be honest, they're just less tempted to spend it, and they physically like seeing their home balance reduce with each and every extra repayment they make. Now, to be very clear, redraw and offset work mathematically the same, but the mortgage offset account gives you far more flexibility in accessing your funds. Third is make it automatic. I know this finance stuff can often feel like a drag, so try and make it super easy for yourself. Set up your salary to go directly into your offset. Pay all your bills from there. What's left over stays there. Also, just so you're aware, quite a few banks now offer multiple offset accounts. So if you're someone who likes to structure their finances by having separate bucket accounts for different purposes, you can still structure things in this manner whilst ensuring every cent is offsetting the interest you are paying on your loan balance. The key to getting ahead with this is not massive changes made overnight, but small deliberate decisions that when compounded over a 30-year loan term, will have you coming out ahead of your projected loan term years ahead of schedule. Now you understand why every dollar should be working for you in an offset account rather than sitting in taxable savings accounts. Besides the offset strategy, there's actually a few other strategies that can help you pay off your mortgage faster. What I've shown you today with offsets is just one of them, but it's probably the most powerful because it doesn't require you to change your lifestyle or earn any more money. But here's the thing. Everyone's situation is different. Maybe you've got investment properties, maybe you're self-employed, maybe you've got some equity you could be using more strategically. The best approach really depends on your specific circumstances. If you'd like my help figuring this out, there's a link down below in the description. Otherwise, thanks for watching and I'll see you in the next one.